Joining us. We're happy to have you at the CFO Network, and going to launch right into a discussion about derivatives, which of course are, I think, a lot dearer to our hearts, everyone's hearts these days since the financial crisis. So let me start by asking you what you make of the concerns of a lot of people in this audience who are primarily non-financial users, and that is that the cost of hedging will rise as a result of the Dodd-Frank regulations that you'll promulgate.
Well, first, let me thank the Wall Street Journal CFO Network for inviting me here to speak, and thank all of you you have lots better things to do than sitting in chairs listening to all of us regulators and government officials speak. But derivatives are absolutely critical for you to be able to lock in a price or a rate so that you can focus on at your companies things that you do best. You know, invest, innovate, compete with other companies. And so they're absolutely critical. I think that the core of Dodd-Frank is to bring the market benefits of transparency and risk reduction to this marketplace. It's existed for 150 years, derivatives. It started in this country, at least in Chicago, around hedging and locking in the price of grain. You know, a farmer wanted to lock in a price at harvest time. But the swaps marketplace has been largely unregulated here and in Europe and in Asia. I think that Dodd-Frank will give CFOs the benefit of greater transparency while avoiding, you'll be out of clearing, you'll be out of margining regimes. I'm sure there'll be a question or two about end-user margining. So I think there'll be a benefit. I think there'll be fundamentally a benefit, and these hedging marketplaces will be more transparent.
The benefit would come in the form of transparency, which would mean lower cost rather than higher cost.
I think transparency and greater competition. Right now, this is a marketplace when you enter into bilateral swap transactions that probably most of you have a handful, at most 10 counterparties that you go to, and it might be 3 or 4, and they're the largest financial institutions usually of this country or the globe. And I think that openness and competition will come into this marketplace, one, because of transparency, but two, because for most of the market, it will have to be centrally cleared, not for CFOs of non-financial companies, but the other 90% of the market that's centrally cleared, then the credit risk will be not inherent in the transaction. There'll be more competition in this marketplace.
Let me ask you something. Do you want to see less use of swaps by companies in this audience? Do you think that is part of the objective here in terms of reducing systemic risk?
I think that companies and municipalities need to use whatever tools are available to them to lower the risk, and I think that swaps are a product that help lower risk. But unfortunately, the financial crisis showed they could also concentrate risk. So I'm going to ask, show of hands, how many people made their 2009 budgets? Oops. So wait, 5, so 7, 8 of you made your 2009 budget. Well, maybe you made it after the crisis because you rewrote that budget in January. So maybe my question wasn't right. But the risk, swaps were part of this crisis. So they're a risk reducing tool, and they should be, but they also concentrated and heightened risk in AIG and other financial institutions. It's that second point. We want to lower that risk through transparency and clearinghouses.
Another show of hands then. How many of you were AIG counterparties for financial derivatives? Not insurance products, but for financial derivatives. Anyone? So I guess the question then becomes why they would need to pay the price for banks' failures to manage risk. And I know you've said that there is no price.
I was saying they did. I think every American paid a price for banks and AIG's failure to manage that risk. And we all paid a price for the regulatory system that failed. It was not just Wall Street that failed, it was the regulatory system. And I think that's what we do. That's what a great democracy does. It sometimes comes together and says we need a stronger regulatory system, like in the 1930s when President Roosevelt recommended what became the Securities and Exchange Commission, or our predecessor. So it's in that, I think.
What about the concern about cash margin? It seems to us that the CFTC and the FDIC have given very, very conflicting signals to at least this public in terms of the need for cash margin on the part of non-financials.
So the question is for end users of derivatives, non-financial firms, will there be any new requirement to come into clearinghouses? The answer is no. Congress decided that categorically, and we've put out rules consistent with that. So the next question comes, does the banks have to collect collateral, collect margin? We put out a proposed rule in April saying, consistent with congressional intent, no, the banks don't need to collect margin from commercial end users. The bank regulators did the same thing, but they added a sentence that has gotten some attention that just says that banks should be extending credit consistent with their credit policies, and that's the one sentence. But that's because they're banks.
So how do you? But isn't there a contradiction there potentially, at least in terms of stipulation towards?
Well, for a number of reasons, I think not. One is what both the bank regulators and the CFTC said is end users are not required to post margin. Two, these are just proposals. You all have an opportunity, and I know your associations have spoken loudly to the bank regulators on the point. So these are just proposals. We'll probably, in the course of these things, finalize these margining rules towards the end of this year, so we have some time to look at these together.
What's your relationship like with Sheila Bair? Is she as difficult to get along with as she might seem to be?
I think that Sheila has served this nation very well. I think we're all going to miss her. Her last day is July 8th, and I consider myself honored to have served with her.
The July 16th deadline, speaking of July, you waived a magic wand there, so to speak, in terms of Dodd-Frank's deadline. But there are some legal experts out there who suggest that deals going forward might be challenged. Are you actually leaving the rulemaking up to judges in this area as a result?
Well, Congress gave us 1 year to complete the task of writing rules along with the Securities and Exchange Commission for this $300 trillion marketplace. Very proud the CFTC, with only a little over 600 people, has substantially completed the proposal phase. We did that in about 9 months. So you who keep budgets and time budgets can say if you completed the proposals in 9 months, we're not going to complete the final rules in 12 months. But we want to get these right. We want to hear from the public. We've gotten 21,000 comments on these proposals. And we're going to take up final rules throughout the rest of this year, working internationally, working with the SEC. So it brought us back to the question, what happens on the 1 year anniversary? And so we've used our exemptive authority to say to basically what happens on the 1 year anniversary is that everybody, the marketplace, gets to wait until we finalize the rules. I mean, that's roughly what we've said through this exemptive authority. And I think it works. But we put that out to public comment too, and you or your associations might weigh in the next week to say if we missed something. Legal challenges are not an issue, you don't think? With regard to this exemptive order, we think it's quite strong. But we live in this great democracy, and many things will be taken to court, and that's the nature of our society. But our approach to rule writing is to do what Congress has said to do, not to overread the law, not to underread. There are many people that come in on either side who might say, can you shave it here? Can you do something less? Just clarify my company out of this. Or there's some people that push the other way. We're just trying to get it in the middle. Well, given the complexity and the fact is it seems we can't even define at this point what a swap is or what a dealer is. We know what a swap is. All right. I mean, is there anybody in the room that doesn't know what a 2-year interest rate swap? I mean, Congress went on for a significant number of pages defining what a swap is. They then said that the SEC and CFTC through rules should, quote, further define it. I see. So we asked the public, how should we further define it? We got 80 comment letters that read like legal briefs. And then we put out a 300-page document to further define. But
what about dealer and end user? That's still not quite so
again,
clear. Right?
Congress was pretty specific as to what a dealer is. A dealer is somebody who's making markets, who holds themselves out in these sort of risk management techniques. We put out a joint proposal. I don't know all the companies represented here. There may be one or two dealers because there may be one or two banks in the room. But I suspect the non-banks in the room are not dealers, but again, I don't know all the companies. If you have 5 or 10 or even 15 counterparties in the swap market, pretty good chance you're not a dealer. If you have a few hundred counterparties in the swap market, it's possible you might want to read the statute. I mean, it may be that you're, helping others do risk management.
Let me put Chuck Noski on the spot, if you don't mind here. What do you make of the impact on your organization?
And Chuck's, you're with?
Bank of America.
Bank of America, all right.
Well, as you might expect, we're monitoring all of the rulemaking across Dodd-Frank pretty closely and have views on each, and certainly in the area of CFTC, we're watching that. We think it will be important to our business, but not overly disruptive.
Gary, off stage, you mentioned profits of $30 billion.
I just read a news report this morning, so it was on my mind.
That Wall Street makes on derivatives. You figured that would decline to 27, and so.
No, I don't know what it will decline to. It might go up. I mean, what we know is that the derivatives marketplace today, the swaps marketplace, is concentrated. It's competitive, but concentrated along large financial institutions. Dodd-Frank modestly shifts the needle on information. Why is that? Because Congress thought that markets are safer and more efficient with that transparency in a number of ways. After the transaction, you all were able to get real-time reporting of transactions. That's the new law, called post-trade transparency. You'll be able to get that on various screens in various ways. Pre-trade, some of the market will come to execution platforms. Not the dominant part of it, but it has to be cleared, it has to not be a block trade, it has to be between financial institutions. But some portion of the market will have some pre-trade transparency where buyers and sellers meet in the platforms. Those two forms of transparency will modestly shift some of the information advantage. I don't know what will happen to Wall Street profits, but it's not a goal of ours to rise them, lower them. Maybe Chuck and others think it might be, but it's not. They'll make it up on volume. But I think that when you shift the information advantage, markets work better. You've sort of democratized the markets a bit more. It'll be more open and competitive. The clearinghouses will be more open. More people. The smaller banks might compete for corporate America's business with some of the larger banks and so forth.
Given the complexity, the obvious complexity and the challenges involved here in meeting that July 16th deadline, I can't help but wonder whether, especially for companies that are just hedging, whether in fact, with swaps, whether in fact it wouldn't have been preferable for Congress to have in fact drawn a line between speculating and hedging by banning naked swaps. So wouldn't we have been able to kind of cut to the chase here on this issue by doing that? Well,
hedgers and speculators meet in a marketplace. So rolling all the way back to the 1860s when the farmer wanted to lock in a price at harvest time, that farmer's hedging, and the person on the other side who's going to guarantee a price at harvest time is often a speculator. Today, 150 years later, it could be one of these companies wants to lock in an interest rate, or you're exporting goods and you want to lock in the value of the euro versus the dollar, and there's uncertainty in Europe, and you want to lock that in. On the other side of the market, there may be a speculator. Our role as market regulators is to ensure that when the hedgers and speculators meet, it's transparent, it's free of fraud and manipulation, that it's competitive and it's open, and that as a regulator we have enough resources and our funding is strong enough to have a cop on the beat. But it's to allow those parties to meet free of fraud and abuse. And in the commodity, there is in the commodity markets where we're supposed to set position limits to protect against some of the burdens that might come from excessive speculation.
Well, I guess in the situation you just described, one party had an insurable economic interest, so that would not be a naked swap. So I guess my point is that it seems to me that there could have been a cleaner solution to all this.
Well, there could have been.
It was part of the original, some of the original proposals in the legislation. Of course, it didn't make it through.
Yeah, yeah. Ron's reminding me of the great debate in the 1750s. I wasn't around, but I mean, under King George II, they had to debate whether an insurable interest in ships.
Right.
And then they said, what happened is there were a lot of ships going down. And
but that distinction, I think, existed in U.S. law until the CFTC, if I'm not mistaken, basically.
No, it still exists on
paper,
on humans. And on homes and things like that. It doesn't exist on credit default swaps on companies, and that's where this debate. Now, this Securities and Exchange Commission was given a lot more authority to police for manipulation and fraud in the credit default swap market, to actually even set position limits if they chose to. I mean, those authorities were given to the SEC.
Let me ask for another show of hands, and this is on the real basic question of whether or how many of you in this room will actually reduce your use of swaps as a result of Dodd-Frank. Anyone? Any show of hands? Well, maybe the concerns that are being expressed in the media are perhaps overstated.
Look, I think we've got a lot to do at the CFTC. But we're committed that any changes be smooth in this market, be phased in. We get a lot of flexibility from Congress to phase the implementation, and we plan to use that to lower cost and lower risk. But also, our eye is on the goal that end users and what's usually called the buy side, pension funds and asset managers and so forth, continue to be able to hedge complex risk and standard risk, and to get more transparency and benefit from markets that are open and competitive and transparent. I think that's the core of Dodd-Frank, and lowering risk of the big financial institutions so that they use on their standard transaction the benefits of what's called central clearing. That's the goal. That's what we're committed to.
Let me ask you a personal question. You were
3 daughters.
you were known when you were at Goldman as a pretty staunch believer in free financial markets. Obviously, you're seen as a proponent of strong regulation now. Is the change simply a matter of what hat you're wearing, or was the financial crisis an inflection point, so to speak, on your road to Damascus?
I liked your use of words. Believer in markets. I believe that regulated markets work best, that some of the great reforms of the 30s or even later reforms in the Delaware courts. I started in the merger and acquisition business, and I remember often a board of directors would say to their lawyers, well, what do we have to do? Do we have to take that higher price, or can we go with these people we like over here? And the lawyers would say, no, the Delaware courts and securities law say you have to consider. You don't necessarily have to take it, but you have to consider that higher price and so forth. I thought that those rules of the road actually were good for shareholders and investors. So I think there's a lot of the markets are what this nation survives on, but it's well-regulated markets. And I do think that the crisis highlighted that we had a vast market, the swaps market. There's $20 of swaps for every dollars of goods and services in our economy. And so it's $300+ trillion of swaps.
And that's leverage.
What's that?
That's leverage.
That's leverage. That's a lot of lowering of risk for companies, but it's also concentrating of risk in the financial system. So I think the crisis certainly informed me, I mean, that we should get some of these transparency and risk reducing that we already have in the securities markets and the futures markets.
Now there are, I think I've heard reports, maybe they're just rumors, that you're also departing soon, or is that incorrect?
Jeez, one, I'm just terrifically honored to be in this job. Two, there's an awful lot more to do. I mean, we've got a lot more to do. The rule writing, we're restructuring the agency. I'm in this job as long as President Obama wants me in this job. It's a great job.
Well,
really
thanks.
An honor.
Thanks. I think we'll open it up for questions now.
Let me ask you a question, Chairman, because we were talking about human resource issues a minute ago. I have a human resource question for you. If what happened in 2007 and 2008 was partly a failure of regulation, we seem to send the best and the brightest in this country to Wall Street, in part to figure out how to get around the regulators. Do you have the people that you need? I mean, no one questions your qualifications for the job you hold, but do you have the people at the CFTC to really keep on top of this incredibly intricate, as you point out, huge market when you've got the kinds of people you do on the other side trying to figure out how to trick you?
Right. Well, first, let me thank you for that wonderful, validation right in the middle there. But I think some people might question me. But we're a small agency. We're about 675 people, which is just slightly more than we were in the 1990s. We peaked in 1993 or 4 at 635 people. And then we shrunk all the way down to about 430. So we were an agency that was shrunk, and we've just gotten back. The futures market that we've traditionally overseen has grown 5 or 6-fold in that time frame, and now we're being asked to take on a market that's 7 times the size, $320 trillion based on controller of the currency figures. I say, like, if we were policing Louisiana, we just got Alabama, Mississippi, Missouri, Oklahoma, I don't know, 7 states in the South. So no, we do not have the resources. We very much need more. The President's asked for about 50% more funding. We're a $202 million agency, our funding. We only spend about $37 million a year on technology. I suspect many of the firms in this room spend far greater than that, so the answer is no, we do not. We have very talented people, but not enough people.
I wasn't just asking about the number of people, but also the quality of the people. Can you get people this is obviously, as we saw, a very complex market. People are playing very intricate games.
Right.
Can you get the quality of people that can match up with the players on the other side?
Let me say, we get very talented people. And it might be a sign of the rough economy and the uncertain economy. We post for jobs, and we often get more than 100 resumes per posting, and sometimes multiples of that. But there's no doubt that when you pay government wages, that's different than Wall Street wages by a country mile. So there's some differences there, but we get very good people. It's mostly about resources.
Why don't we open it up to questions, comments in the back? And identify yourself for the chairman, please.
Sure. Jeff Wallace, Greenwich Treasury Advisors. I hear all about these clearinghouses. How exactly will they work, and how will they manage the credit risk of the banks?
Great question. Clearinghouses have existed in this country since the 1890s, and they act as standing between a buyer and seller of a contract that will be outstanding for months or years. Originally it was months till harvest time. And what they do is, if one of the parties defaults, they'll complete the transaction. And how do they do that? There are 2 key things. One is, every single day they value the transactions based upon market pricing. So it's a daily valuation. And 2, they collect collateral or margin, that which a lot of corporate end users said, well, not me, I don't want to do that. So by daily valuation and collecting margin, in case one of the 2 parties defaults, then they can unwind the trade. What's critical is that it's only clearinghouses just only stand in the middle on transactions that have available pricing feeds, reliable available pricing, because if you can't price the asset, maybe it shouldn't go into the clearinghouse, and that there's some liquidity that you can actually unwind the position. There are international standards. This is actually one area, there's a pretty good set of international standards. Our rule writing is consistent with those international standards. We've been regulating clearinghouses for decades. The largest interest rate swaps clearinghouse has been registered with us for 10 years. It's out of London, and we co-regulate it with the UK regulators. But it has close to $300 trillion of interest rate swaps in it voluntarily, and then the mandatory thing will come later. Does that help?
Do you have the power to change the margin requirements?
We just gotten that in Dodd-Frank. We had not had it until Dodd-Frank, but Dodd-Frank says that we can set policies and procedures to protect the safety and soundness of the clearinghouse. It goes to the safety and soundness of the clearinghouse. It does not go to trying to affect, we're not a price-setting agency, and some people have asked about margin regimes in terms of leverage and margining for what it might do to the markets. The Dodd-Frank was very careful and clear. It's just about the safety and soundness of the clearinghouse or safety and soundness of the dealers. And that we're just supposed to do the policies and procedures, and then they set the individual margins. And we've done that. We've proposed a rule last December. We're hoping to finalize that rule this fall.
Other questions or comments? Yes.
Name is Zamir Roth, and I'm with Calpine Corporation. Our business is very physical at the basic level. We buy natural gas, we burn it, and we produce electricity. But we also sell very customized physical product, and we use financial swaps to hedge our position. And sometimes we have to take both sides of the trade because the market knows our natural position. And if you read the rules, there is an argument that we could be viewed as a dealer, even though there's an end user exemption. How do you view that position, and what is your take on that?
I don't know Calpine's business well enough, so I don't think on camera you'd want a determination as to Calpine's, whether you're a swap dealer. But most commercial enterprises, the vast majority are not swap dealers. Some within the physical commodity area deal in what's called forwards. We do not oversee forwards, and Congress has clearly said not to. That's where somebody actually has an intent to deliver electricity in your case. But if it's only financially settled, it's never an intent to deliver it, it may be what's called a swap under the statute. And then the proposed rule we put out relates to whether you're known as a market maker, whether you make markets, whether you're accommodating demand of others, instead of fulfilling sort of your hedging, but accommodating demand. And I don't know, I sometimes think of it as if Calpine or another electricity company is accommodating demand and has hundreds of sort of downstream folks, it's possible you should come in and see the staff and and comment on the role. The one area that this has come up and has sort of been a very constructive part of dialogue is electricity companies, where a lot of what you do is really forwards, but there may be this portion that. And we've asked a lot of questions, and we're getting a lot of feedback. And
we have been providing feedback.
Good.
I appreciate that.
Over here.
I'm Scott Spindler. I'm with Tesoro Corporation. We're an independent oil refiner marketer. There's a lot of talk about the effect of oil and gasoline prices on the economy and the economic recovery. There's also a lot of talk about the effect speculative traders have on those markets and frothing up the markets and perhaps inflating the price of oil and therefore gasoline unnecessarily, or at least not tied to supply and demand fundamentals. Can you comment on efforts to limit speculative trading in these markets?
The markets we oversee are markets where hedgers and speculators meet in a market, and Way back in the 1930s, Congress gave us authority, actually directed us to set limits on the positions of speculators in a market to, I guess the words were, eliminate or prevent the burdens that might come from excessive speculation. Congress didn't do any more defining. That was kind of the core. In Dodd-Frank, that was extended to the swaps market, and then the definition of the exemptions for bona fide hedgers, probably like yourself, got narrowed, particularly that swap dealers would have a harder time being a bona fide hedger. So we proposed rules in January of this year. We got over 12,000 comments. We're looking to try to finalize that rule. I think it's critical that we do this. Congress has mandated that we do it. And we're working on that, but with 12,000 comments, it takes a little bit of time. The oil markets and natural gas markets that you mentioned, we put out reports every Friday, and you could look at our website and see that producers and merchants are somewhere between 10 and 20% of the long interest, and sometimes 20 to 25% of the short interest. That means 75 to 85% of the markets are financial actors, swap dealers who may be hedging other people's risk, hedge funds, and so forth. So it gives you a sense of, the markets today. Sometimes there's $4 of open interest in the financial actors for every dollar of open interest in the what might be called producer merchants or hedgers. And that's why I think it is critical that we have strong anti-manipulation, have a lot of transparency, and the like.
Interesting.
53 seconds. One question?
One quick question. Lee.
Hi, Lee Shavel, NASDAQ OMX. Chairman Gensler, obviously the futures markets are to a greater extent global markets in comparison to, let's say, the equity markets. How are you working to try to maintain consistency of regulatory priorities with other regulatory regimes and avoid regulatory arbitrage, as many of the companies within this room, I'm sure, could execute in a variety of foreign venues in the futures market?
In 20 seconds or less.
You're right. Capital and risk knows no geographic boundary. It feels like that we're talking to international regulators on a daily, but it's probably weekly basis. The President and 19 other heads of state came together in September of '09 and said there'll be mandatory central clearing, mandatory trading as appropriate, and higher capital for standardized swaps. Europe's moving forward right now, and I think by 2012 we'll have largely consistent but not identical regimes.
Great. Chairman Gensler, thank you very much.
Thank you.
Thanks a lot.